Good evening. I'd like to welcome you to the Hurley Investments Financial Services Commentary for, I think we're on Tuesday, December 4th. I will be doing, looks like, one or two more of these before I take 2 weeks off. And then come January, I'll do it for a week. And then I'm going to be going to 3 times a week. I'm going to be doing a Monday market recap like we do tonight. I'll do a Tuesday small little education looking at possible trade opportunities. And then I'm going to do a Thursday adjustment just to answer questions. I will start charging them for it, but clientele, people that have been with me for years will not. They'll all have it for free. But I'm working with a couple other educations that any new people that are coming over to this, we're going to charge. In fact, if I was to do something like this 3 times a night, from those of you that are here, 3 times a week, so I'm probably doing it for between 3 to 4.5 hours a week. If you were doing some of your own trading or you wanted that extra information, what would be a good price point per month? I know what's been suggested to me already. So that's an interesting. Lance says, I would pay 20, 25 bucks a session. So if we had 12, that puts you at that 240 to 300 range. And again, you guys will all be getting it for free. Clientele gets it for free. People who have been with me have got it for free. Any other ideas? Well, it looks like they're going to do something for around $199 a month. So just curious, just kind of bounce it off you guys. All right, here we go. What do you want to talk about today? Give me a quick answer. What is the first thing you would talk about today in regards to the markets? Market sell-off. Big down market. And we have bear market. Well, not necessarily a bear market, maybe from the highs, but not quite yet. You know what my first thought was? Not that. My first thought was, I cut and I pasted it. So here is my first thought. I'm going to pause you for a second because I want it the way I want it. Let me get this back up really quickly. My first thought came down to, and I don't know if you guys know this or not, the stock market is closed tomorrow. So my first thought after a day like today was, thank goodness the stock markets are closed. And I grabbed it really quickly. Markets closed Wednesday, December 5th, 2018. On Wednesday, December 5th, the stock, bond, and equity-based options markets will be closed for a national day of mourning to honor former President George H.W. Bush. So the short answer is we get a day off. And thank goodness. Because in all honesty, I took a beating today. In fact, I've done a couple things wrong, and I hope you don't mind, but let me share with you some of my oopses. So my honest thought today was, and it looks something like that, or I mean, this might be for the first time in 12 years that I may not beat the S&P with everyone through my my clientele. Usually I might be close to the S&P with my lower end group, just meaning the $200,000 or less. 200, 750,000 is my medium range group. 70,000 to higher, which is really just about 7 individuals that have $1 million to 3-ish with me. I'm now worried that I might not even meet the S&P 500 with a couple of my groups. And the issue is, well, Kevin, what did you do? What's different? What's causing the problem? And my worry is the new normal, and it's really just for this year, right? This year is no longer moving on historical patterns. Support and resistance, and we know this already. And I'm talking about long term, not short term, are no longer working. Kevin, what mistakes have you made this year? Well, from Apple, I did really good on Apple from 240 down to 200, and then from 200 down to 186, 184, a $16 drop. I had nothing on for protection. Options expired, looking for a little bounce off of 200. Things were okay. Off we went. As I talked about last week, from 288 down to 250, a $38 drop on Baidu. Made $36.80 of the way down. 250 to 220. 250 should have held. Don't know what I was thinking. I only made up like 6 of that $30 down. 220 to 200 did very well. 200 to 185 made like $4 of that $15 movement down. Part of it was placing some puts on after some expiration. Part of it was expecting a bounce and not receiving it. Part of it was the fact that things just got screwy and I missed it. Facebook, I booked a great profit for people. And then I've taken roughly half of that profit into leap long calls that are getting their butts handed to them. Banks this year, we're going to get a 1 percentage point increase. For most banks who are doing any type of lending, you should receive a much higher revenue when you get to charge more. The spreads have widened this year. Advantages for banks. Well, banks have been doing horrible. They've just been doing awful this year. Yet, it was kind of funny because banks, technology, and healthcare are supposed to be the big 3 winners this year. Technology is now flat. Banks are down as a whole. And healthcare is up slightly. Just a year that, in all honesty, the beginning of the year, I loved it, significantly beating the year into April. From April through that August time frame, put some protection on in a sideways moving market or some upward moving markets that we really didn't need. And then my protections kind of bit me in the butt on a couple support levels the last 4 weeks. I'm frustrated with the market. Plain and simple, to be 100% honest, I'm frustrated. How frustrated are you? If you look at yesterday, for those that own Apple, I actually added to the 185s or 180 long puts, we added some short puts at 175. Was trying to make up a little since Apple was obviously looking like it was going to go to 200. Added some short puts on Bank of America, trading up at 29. had 27.5 long put still in place. I thought I could do some 26.50. Bank of America is down at 26.90 today. I added some short puts onto some positions that we didn't need. My leap long calls this year from taking some profits last year, not working out for me. Bank of America leap long calls, I had to roll out in time. I had to do only a fourth the amount of contracts, take that same amount of money, and give myself some extra time. Facebook, I've doubled down on. Cost me money. Not getting back up to 200 anytime soon. The only leap long calls that have worked for me this year have been Visa. Leap long calls on Visa are looking pretty good. I would look to do with the pullback on NVIDIA, some leap long calls on NVIDIA and some more on Visa into the future look like an opportunity. But when you're frustrated, the key is, what do you do? What do you do? In an uncertain market, you're going to go back to basics. Long stock and long puts. Keep it that simple. Don't mess around with trying to pull off short calls. Don't mess around with trying to add short puts. Keep it simple, stupid. That KISS principle. I've got a couple people who are looking for opportunities. I would have thought on Monday our opportunity was here. I would have thought looking at a bullish, let me get this moved out of the way. Looking at a bullish Dow Jones, we were set up for a Christmas rally. We're still technically bullish. We do have a crossover on the RSI. The 5 and the 20, the MACD are all still on a bullish signal. We have not got our crossovers for bearish. We could say the same thing for the S&P. It mirrors the Dow. The problem with both the S&P and Dow, what did we break through today? What did we break through today that seriously damaged any chance at a Christmas rally? Can you see it on that chart? The 200-day, what else did we break through? The 50-day and the 200-day. Simple moving averages. Some pretty big institutional averages. Part of me wonders, where were the money makers, the market makers? Where were the buy orders at? Why is there such a difference? But again, we got muddled. I think I caught that off at CNBC. We had muddled messages from numerous individuals in regards to the Trump-China trade truce. Information had to be corrected from one source to another. We had to deal with the fact that so many places are producing oil. Once again, is it a market slowdown? Or is it that we have Middle East, Russia, and United States all putting the spigots on? In fact, I heard this on CNBC today, that Texas now produces more oil than Iran. Spigots are on. Taking a look at the NASDAQ, same thing. Basically hit the The 50-day broke above it. I was thinking, all right, we could possibly get above the 200. Boy, never made it above the 200, right back down. We're in a death cross now for the NASDAQ. Looking at about an 8.5% drop from here. I find it very interesting because if we look at the ISM manufacturing number, most, if not all, components suggest faster expansion going into the beginning of next year. The Purchasing Managers Index, ISM Manufacturing PMI, registered a 59.3 reading. Expectation, economy was slowing down, 57.2. It missed it by 2.1%. Obviously, we've been in a range between 57 to 61, but we were bouncing off of the low end of the range, and it's a huge sign for positive manufacturing. In fact, if you read through here, it tells you that November is the 27th month in a row above the neutral 50 line and the 115th above the 43.2% threshold, consistent with expansion overall in the economy. Some of the key components, I found it very interesting. The new orders index came in at 62.1, up from 57.4. Production index, 60.6, up from 59.9 when we had 4 weeks where our markets were struggling. Historical readings above a 51.5 are consistent with growth in the industrial production indexes. Employment index rose to 58.4, up from the 56.8 in October. I don't consider this too important because it's probably seasonal. Suppliers deliveries, 62.5 down from 63.8. Price index eased considerably from elevated level. The index fell 10.9% from a price index. Well, I think that suggests that material cost pressures have been increasing. That happens when you go through a tariff-like scenario. But here's the biggest point. Customer inventories are still considered too low, falling to a 41.5 from a 43.3 in the prior months. Indexes results below 50 indicate consumers' inventories are too low, which means that you might have, there's only one industry report excessive inventories, electrical equipment, appliances, and components. So I guess I was just going to say, with all the volatility, the main push for our economy and GDP and slowing down just isn't there. There's not a recession, at least out to the next 6 months of next year. The numbers don't justify it. Which means on a day like today, as hard as this is, as it's killing me for some of my end results, today was sentiment driven, and how long will it last? Any comments on what I'm showing you right now about today? Any comments that you'd like to add out there? So what would I do different? I think actually, Lance, I'm pretty sure you asked that last week as well. So Kevin, what are you going to do different? If you're giving away some of your collar trading or some of your year-end results, what are you going to do different? And in all honesty, Lance, I have Keeve that I work with that also is asking me the same question. Are you going to do some things different? Or maybe do it different into next year? And I've got to be honest with you. If I was looking at this year, I might have had a better use for using short calls, obviously through the first quarter, through the next two earnings events, the last one and the one in April through June. It would have hurt me. So I could be using longer term, bigger credit short calls because I always can roll those out and up in time if I need to. So I didn't want to cap to the upside because we've been in a 10-year bull market run, and it didn't seem like it was going to be ending this year. I actually thought maybe I'm a little over concentrated in technology and financials, the banking industry, and not enough in the healthcare or energies. But if you were in energy this year, you've also taken a loss. The XLF is down for the year as a whole. I would have had to have done a better job picking my energies, which means Dominion would have been one that might have helped me. Chevron, Exxon, Murphy Oil, Valero would not have helped me this year. In fact, would have hurt me pretty. It would have stung me. Really, when it comes down to it, I think the thing I would be doing different is less long-term trades, the shorter-term trades, to work for a 4 to 6 week period versus going a month instead of going 2 to 3 months out in time, would have made a significant difference in some returns. I think I should have, as just a little help for some of my leap long calls. If I had 4, I could have done 1 or 2 long puts just as a precautionary measure that I haven't done. So that could have been something on some of my leap positions. Again, for the most part, I had some people on Facebook, though, that we got out at a nice profit. Same thing with Bank of America. Same thing with Visa. We've been in it for a couple years, and I just positioned long calls. For some people that joined at the beginning of the year, I actually just added them to those positions. So they lacked a booked profit. So what would I have done different? At this point in time, I can't tell you there's a lot that I would have done different. I'm still in the process of figuring that out. So Lance, good question. Way to embarrass me a little bit in front of the group. Way to have it recorded, no less. But that's the honest truth there. David, one more question. When I think I answered already, why did you choose to be in what you chose to be in this year? Again, my Baidu, which is hurting me significantly, is my international play. Beginning of the year, we weren't so worried about tariffs and so forth. It always had done well in the past. It's done phenomenal through its earnings. It just literally is down from 288 to 180 today, maybe a little bit below that. Let's see where it finished. Took an $11 hit, I thought. Baidu down to 182.66 today, down $8.67. So we're looking at a $206 loss on sentiment and uncertainty. Apple, it was a great win for me this year. Thank goodness I protected. I'm still profitable overall in it, but shame on me for playing a 200 support level. Facebook, Bank of America, I'm in what I'm in because I agreed at the beginning of the year, and the rhetoric hasn't changed. Technology, financials, and healthcare should have done really well going into this year. It's the same call for next year still. Financials, because now, which is really stupid, we know we're only going to have a couple interest rate hikes. So maybe the consumer won't be so scared. Maybe you won't have the slowdown in the housing, as people thought, hey, it's too high for me now to afford a house, paying a whole interest point higher, which is anywhere from 25 to 33.3% higher than it was last year in interest on the purchase of a home. Technology still has plenty of money where they don't need to borrow some of that higher money, higher priced money into next year. Healthcare, because of some of the innovations. In fact, I've got a client that really likes the IBB, the pharmaceutical ETF. So I'm in what I'm in because of my end of the year, beginning of the year research. Ford should be up in that $17 range. Valuation wise, price rise, everything is doing right. It should be significantly higher. I went to Ford. We had some big pricing into Under Armour, primarily because it dropped from 52 down to that $16 range. Well overdone, well at a Fibonacci at 66%. On a 50% retracement, we could get back in. Everything that typically matters by way of research has just not mattered this year like it does. So it is frustrating, but that's why I'm in what I'm in. Are there any other questions about today or about the portfolios? As you're thinking about it or typing them in, where are markets end this week? I don't know. I would look for a bounce on Thursday. I do think it's going to help us and let markets calm down. Really, the end of today was a sell-off like a Friday. And I do think any positive rhetoric could give us a significant bounce on Thursday. And then we might give it all away on Friday again. But I would be foolish for me to give you any type of prediction for next year. I thought before today, as I prepared this yesterday, World S&P end in December 2008, I thought would be up 2.5%, really looking more at that 2.8 to 3.2 range for a Christmas rally. I'm going to stick by that for this week, but by next week, I'll know if that's a fool's game or not. Earnings, Marvel knocked it out of the park. They were up 5% after hours earlier. Let's take a look and see after their news conference if they still did okay. Marvel, after hours up 4.7% at 16.24. These guys have calls in that 21 to 25 range. So I am a little curious to see if you're to ask me on a new trade. Marvel might have a pop. It might be an interesting spread trade, a bull call 16 to 17. We'll see where it opens up on Thursday. Again, it would be shorter term. I would be getting into it for a January, but looking to be out in 2 weeks, whether I've hit a 20% profit or not. I'm not sure. It's kind of interesting. I can't remember where we just had a market close for a presidential request. So I don't know if we're going to get our ADP unit labor cost ISM services beige book tomorrow. I'd bet we will not get them, and we will see those on Thursday with initial continuing claims, trade balance, and factory orders. Friday is the average work week. I would expect we'll see everything good there. It does look like payrolls for non-farm and private are going to be just fine. Internationally, not much to really move us. Some of the standard stuff is there. Thursday, American Outdoor Brands Corp is coming up for earnings. Red Hat on the 19th. Red Hat's an interesting one. No bad news has come out, and they shot up to about 168 from what, 120? 120 to 168. Going to be bought out at 190 from IBM. Everything still looks to be okay for it. Do you protect Red Hat through earnings? You probably do. You probably go out of the money a little bit to make it cheaper and protect Red Hat for their earnings. This should be the earnings, considering this is supposed to close in June of next year. This will be the earnings where some details will come out. Would Red Hat go up or down based on their earnings? I don't know. It really should be at $190 a share right now, and it's not. So it'll be interesting to see for Red Hat on their earnings, but I do believe I'll probably go out a couple months. They did lose 51 cents today, but I'll probably go out a couple months for something like a 170 or an off week, a 172.50, maybe $5 below, just in case something blows up, that I'll have some protection as it heads down. I found an interesting article. People ask me all the time why I'm in Visa. This article gives you every question that you need answered, but it really comes down to one chart. Purchase transactions on global cards in 2017. Visa had 147.9 billion. MasterCard only had half of that. UnionPay, Diners Discover, JCB, American Express. This answers it right here. Not only that, but they did excellent on purchasing Visa Europe to juice their money again. So anyone that wants to know why you should be in Visa, I checked all the numbers on this. Really, really good research done by Jaime C. I'm saying that wrong. It's an Asian name. I apologize for butchering that. But really, why I'm in Visa, global expectations, where they're going, fabulous data. I agree with all of it 100%. This is why I'm in Visa. This is why I think you should get into Visa if you're not. Would I use a leap long call on it? Most definitely. If you can't afford the shares, a leap long call would be a great way to do it. Some out of the money put protection, but fabulous information on Visa. I can't speak enough for how they created this. Trump's China's truce sets up a make or break promise to overall America's trade policy. Obviously, we know that's a bogus bungle, but I did put some information on that. This also came from just 9 hours. This came from, though, where did this come from? I believe this came on Monday. So this is Monday's information. Part of it might have changed, but I did want you to read about some of the contradictions they were talking about on Monday. U.S. and China, two big animals learning to coexist. Just an interesting article. Apple versus the S&P 500. Which is a better investment? Obviously, a little justification on why I'm in Apple in regards to, is it still a good buy, and is it even a better buy now that it's down? So, with those things said, I don't think I have anything else other than what I already showed you. Oh, the Bank of America story. A lot of people ask me why I'm such a big fan of Bank of America. It obviously has underperformed in 2018, bit me in the butt. But again, great information on Bank of America and what's working for it. The expense story, fabulous. Non-interest expense becoming lower and lower every single year. When your non-interest expenses are lower, you're going to create more revenue. With more revenue, more opportunities to expand the business. I just thought it was a pretty well done piece on Bank of America versus some of the other banks, Citi, Wells Fargo, JP Morgan Chase. It's also relatively cheap. If anyone wants to ask why I'm on Bank of America, here it is right here. They've underperformed, but they're likely to play catch up in the next 2 years as management improves the banking cost structure. Plain and simple. All right, questions. What questions do you guys have for me? What other questions can I answer for you? Well, I know someone's going to have one, so let me go to this really quickly. Let's talk Google really quickly. Google, but I want to switch it to I'm going to switch it to a day chart. That didn't work at all. Give me a quick second. Give me a quick second. All right. Let's see. Because 2 of you are here. We go to a chart. For the 2 of you that are going to ask, what's going to go on with Google? I got my first alert right here at 12:30 Eastern. We're below 1080. We watched it, came right off a support level short term, back above 1080. I thought we were in a great position from this point on. In the last hour, it fell away. The last half hour was my worry. Because for a certain point, I'm going to have to extend a trade out in time for a short put position. Great to see it coming back after hours, up $7.53. I've got trades that are happening here, I believe, for December monthlies and or Januaries, but I really need Google to be above Alphabet, to be above 1080. Good to see after hours. It's heading back that way. But for those of you that were asking about today, I didn't have to worry about Google truly till the last half hour. And by that time, it was a little too late to do anything. So for those of you that are going to ask about Google, a lot will tell me on Thursday. But worst comes to worst, I might roll out and down a bull put trade to buy me some more time. That's my look on what I might do for Google, but it looks like we might get a pretty good bounce, so we're going to be okay. If I bounce through a couple more here, just out of curiosity, bounce after hours from forward by 1%. Baidu is not getting the bounce. That is disconcerting to me, but I do have 185, 170 long puts in place. Apple is also not getting a bounce. That is disconcerting to me. Visa's getting the bounce. Love it. I think we'll be in good shape there. Disney, another core holding. Not much of a bounce, but I can cash in some 115 long puts in that place. Zion's Bank hurt me today. No bounce after hours, so we're not getting a bounce on financials. It looks not really a bounce there either. So what I was going to throw your way, I can't do it. The bounces seem to not be related to sectors. It's on individual stocks. So I don't have any good answers there for you. All right. Any other questions you guys have for me that I can help you with? Or that I can mention or show to you, or anything you'd like me to go over? If not, I'm going to wish you guys a great evening. Stock market is closed on Wednesday, so look for a most likely a bounce on Thursday. And you guys have a wonderful evening. Talk with you soon. Bye-bye.